Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. Hi, welcome to Investing the Templeton Way podcast, a podcast that explores the world's most intriguing investment topics from the overseas markets to mastering our own minds. I'm your host, Lauren Templeton.
And I'm your co-host, Scott Phillips.
I am happy to introduce to you today's guest on the podcast, Dr. Aswath Damodaran. Dr. Damodaran is known as the Dean of Valuation. He is a professor of finance at the Stern School of Business at NYU, where he teaches corporate finance and equity valuation. He is the author of several books on equity valuation, including Damodaran on Valuation, Investment Valuation, The Dark Side of Valuation, and The Little Book of Valuation, and several books on corporate finance. Prior to joining NYU, Dr. Damodaran served as visiting lecturer at the University of California at Berkeley. He has been profiled in Business Week as one of the top 12 business school professors in the United States. And Dr. Damodaran generously makes his classes available for free online. And I would encourage you to visit his website at damodaran.com. In today's episode, we discuss valuation and the importance of intellectual humility in the investment process. So let's get started, Scott, and welcome Aswath.
Oh, thank you. Thank you for having me.
Well, I'd like to start by learning a little bit about your background. I know that you grew up in Chennai, India, and moved to the United States in 1979. Can you tell me a little bit about your childhood and your journey to the U.S.?
Well, I mean, in a sense, I grew up in a world very different from the world we live in right now, because I grew up in India when India was still perhaps a century behind in terms of technology. I mean, I grew up without TV, and I grew up with a very close family, a very large family, an extended family. So I have no complaints. I had a childhood that encouraged me to be imaginative and to think on my own. And I think that stood me in good stead, because I think it's a skill that we are at risk of losing in a world where Google search brings everything to your fingertips.
Mm-hmm. So you grew up an independent thinker?
I don't know whether I was an independent thinker. I was a creative thinker, because I had nothing else to do, and imagination was what filled your time.
Yes. Do you go back to India often?
Just once a year, because I've been away from India 33 years, or actually more than that, 43 years. So I've spent the bulk of my life in the U.S. So I have relatively few connections left in India outside of family. Mm-hmm. So I go back about once a year, maybe. That's about it. And for short visits, because outside of my family, there's nobody else for me to see.
Yes, India is a wonderful place to travel to, though. Scott and I went, I believe, in 2019, and we went all over India on an investment research trip and really enjoyed ourselves. Met some wonderful people, met with some very interesting companies and CEOs, and of course had some great food. So we enjoyed India. But tell me about your journey to the United States. So you came to the United States, and did you immediately enroll as an MBA candidate for UCLA?
You couldn't come before you enrolled. I mean, you can't get a visa without being a student. So the sequence is you get into a university or a school first, and then you apply for a visa. So I actually got into the UCLA MBA program, and that was my entry into the US in 1979. I got my MBA and PhD at UCLA. And then, I got my PhD in '84. I taught at Berkeley, UC Berkeley, for a couple of years as a visiting professor, and then came to NYU.
Wow. What led you to your interest in investing?
I don't think I'm that interested in investing. I'll be quite honest. I think, in fact, we're too interested in investing, and that perhaps gets us into trouble. I
Mm-hmm.
think we spend too much of our time thinking about markets, too much of our time thinking about stock prices, not enough time thinking about our own lives. So I think it's actually unhealthy, the kind of obsession people have developed with markets. And social media has fed into it. I think we become worse investors because of our connection to markets and the ease with which we can track markets and what other people think about them. If I had my druthers, I would turn off. I spend very little time obsessing about markets. I'm a teacher. I mean, I tell people, look, if I wasn't teaching finance, I'd be teaching mathematics or algebra at a high school. I'm a teacher first and foremost. My interest in investing is secondary to my interest in teaching.
Mm-hmm. I agree with that. One time I asked Uncle John Templeton, about managing money in the Bahamas, and he said that his results had gotten a lot better when he moved there. I asked him why that was, and he said, well, I think it's because I get the Wall Street Journal a few days late. So I do think that he shared that viewpoint that you should disengage from the markets and read the Wall Street Journal a few days late and take time to reflect on it, not be plugged into CNBC. So if your passion is teaching, and I find it just incredibly generous that you've made your classes available online for free. Can you say a bit about why you made that decision and if NYU objects to that?
There are two parts to the answer. First is, if you think of teaching like acting, you want the biggest possible audience. So it might seem like I'm being selfless, but it's actually a very selfish act. If I'm going to teach, I want 3,000 people watching my classes, not 300. And when I started, that was my hope. It ended up with social media and the connections we have now, 300,000 people can watch a class rather than just 3,000. So really, if you're a teacher and you want to reach the broadest possible audience, then you want to make your classes available to everybody. Now, clearly, if NYU had a choice, they'd have monetized that right from the beginning. But early on, it wasn't even a question. I started putting my classes online 20 years ago, before it was even a thing. I actually had a camcorder at the back of my class that recorded my classes, put them on videotapes, converted them into very, very bad videos online. But I've been doing this for a long time. So it's something that they did not think of initially. And by the time it became a thing, and lots of people were tracking it, it was too late for them. In a sense, if you claim your mission is education, how can you then step in and say, well, you can't educate people? So I hoisted them on their own petard. I said, look, your mission is education. I'm just educating people. And since I'm not charging for it, and that's something I've never done, they could not claim that I was making money off something that I was doing at the university.
I see. Well, I would say that one of your skill sets is taking very complex subjects and making them very easy to understand. That is certainly something that comes across in your lectures that I have seen, in podcasts, and in your writing. It's very clear. So I would encourage everyone to go to your website and become acquainted with your work. It certainly is generous that you make that available to everyone. And I'd like to commend you for that. So tell me, what are your thoughts on valuation today in today's market? Do you have any thoughts on the current market today?
If the question you're asking is the market fairly valued? Is it close to fairly valued? I would say it's closer to being fairly valued today than it was at the start of the year.
Sure.
One measure that I compute on a monthly basis is an implied equity risk premium. Sounds fancy, but here's all I do. I take the level of the index, the S&P 500, and I back out from it what expected return people can make if they bought stocks at that price. Mm-hmm. It's completely model agnostic. You can't accuse me of being a theorist. I'm just computing an IRR. This is how much you paid. These are your expected cash flows. What kind of internal rate of return can you expect to make? At the start of 2022, that number was 5.75%. In other words, people who are investing in stocks and pricing them to earn 5.75% as return every year.
Mm-hmm.
That's the lowest number in as long as I've been tracking this. I mean, I have the numbers going back to 1960. And this is the lowest number that you've ever seen in the market. So the start of 2022, if you ask people why investing in stocks, their defense was, what other choices do I have? T-bonds are at 1.51%. 5.75% is a terrible return on stocks, but that's the best I can do. But the last 10, 11 months have kind of changed that perspective because all of a sudden the world has shifted under us. We've returned to a more normal world. And for young people who've grown up in the post-2008 world, this the fact that mortgage rates are 7% and T-bond rates are 4% seems outlandish, but this is the way the world used to be before 2008. So it's going to take a little bit of adjusting. And what you've seen this year is markets adjusting back to a new norm. And to be quite honest, markets have been remarkably resilient this year. In fact, I'm surprised that they haven't dropped by more than they have, because adjusting from a 5.75% expected return to close to 9%, which is where they are now, takes a lot of doing.
Yes, that's true. Your comments remind me of recency bias in the market. And I'm always reminded by a quote by an economist named David Rosenberg, who says, I get asked repeatedly the statistic that troubles me the most, which is 13 million. That's the number of people who have joined the financial industry since the last credit collapse ended. These youngsters have only known bull markets and everything from weed to fangs to Picassos to crypto, uber low interest rates, endless quantitative easings, and economic expansion. And are they ever in for the surprise of their lives? So when I think about that in today's market, we haven't seen an inflationary environment in a while. So how do you factor in inflation into the way you think about investing?
No, inflation is always part of investing, but when it's not that the level of inflation that matters. It's the stability of inflation. I tell people, look, if you're given a choice between two economies, and one has 5% inflation, the other has 2% inflation, and I said, which one would you pick? People say, I'll pick the 2% inflation. But then if I added a qualifier, which is in the 5% inflation economy, inflation is always going to be 5%. It's guaranteed to be 5%. But in the 2% inflation economy, it's going to be 0% or 4%. Then your choice changes. It's easier to invest and run businesses in an economy where inflation is stable than when inflation is unstable. So my response to the inflation argument is, don't get focused on the level of inflation. Look at the uncertainty about inflation. And what 2022 has brought is not just higher inflation, but more uncertainty about inflation. And that's tough to deal with. It's tough to deal with in business. And you can see why. You don't have to think deep. I mean, if you run a restaurant, you're not sure whether inflation is going to be 7% or 3% in the next year. Everything becomes more difficult. When you negotiate the pay for your employees, the prices you put on your burritos, you're not sure what to do. And that uncertainty affects businesses. It affects how much gets invested, where it gets invested. So it's not so much the level of inflation that's going to take getting used to. It's the uncertainty about inflation. Because for a decade now, we've had low and stable inflation. In fact, I did a table on inflation where I looked not just at the level of inflation, but the standard deviation of inflation during a decade. So basically, I looked at the inflation every year, computed standard deviation. 2011 through 2020. Not only had one of the lowest inflation rates on record and the lowest standard deviation of inflation. And when inflation becomes low and stable, you tend to forget about it. When inflation becomes unstable, you can't afford to ignore it. You've got to bring it into valuation much more explicitly. So it's not like inflation is not in valuation. Now you've got to think about it explicitly. And for a lot of analysts, that's either a lost skill because they've forgotten how to do it, or they never learned how to do it because they've joined the markets too recently to have learned how to deal with it.
Aswath, this is Scott. I have a question just in the context of everything that's happened in the last year. You articulate the inflation arguments very well and how it affects valuation. But going back to 2021, one of the things that we saw that kind of really got our attention was around that time, we counted 718 stocks trading in the U.S. for more than 20 times sales. Now, those are some really expressive valuations, to say the least, expressing a lot of certainty. What did you make of that phenomena? What was going through your mind when you saw valuations explode at that level?
Well, some of this is just the fact that the market has changed. I mean, pre-1990, if you wanted to go public, you had to wait as a company. You raised capital from venture capitalists, you grew your business, you established a business model, and then you went public. I tell people to go read the Apple and the Microsoft prospectuses and compare them to the prospectuses of Airbnb or Uber. And what you realize is Apple in 1980, when it went public, was already a company that had formed itself. You knew what it did, it had a business model. It was actually making money. And in a sense, that's what companies did. The 1990s kind of broke the mold. I mean, companies decided that they could jump a step. They didn't have to wait to have established business models before going public. Public market investors would invest in them. And the bet turned out to be a good one because the dot-com boom was based on that premise. Then you had the dot-com bust and people said never again, but the door had been opened. So what you saw in the last decade was actually companies using the dot-com door to enter the market, saying, look, we don't have a business model yet. We haven't figured out how to make money, but we have lots of potential. And people invest in it. But for that to work, you need risk capital that is ready to go. I mean, I divide the world into safety capital and risk capital. Safety capital is capital looking for safety, to invest in low PE stocks. You can think of old-time value investing as safety capital. Risk capital is money directed to the riskiest part of every market. In public markets, as you pointed out, it might be companies with lots of potential that are money losing and potentially in danger of going under if they don't get the capital. In private markets, it's angel startups as opposed to more established startups. In real estate, it's the most levered real estate. In cryptos, it's untested collectibles as opposed to tested collectibles. Gold is a tested collectible. Cryptos are untested collectibles. So risk capital is what goes into those markets. And I think we've come off a decade where risk capital was just available in incredible abundance. I think it was too accessible, too available. And I think 2021 was in many ways peak risk capital. And the question you could ask in 2021 is, how long will this last? How long will risk capital continue to supply money to these companies? And the answer we got in 2022 was maybe not that long. So 2022, the big story for the year, in addition to inflation, has been the retreat of risk capital to the sidelines. And it's shown up in every risky asset class. Many of those companies that were trading at 20 times revenue saw a huge drop-off in 2022. In the bond market, the lowest rated bonds, high yield bonds, had a terrible year relative to the better rated bonds. And in the collectible market, it's played out as a kind of a meltdown in cryptos. And cryptos have other problems as well. But the retreat of risk capital has been catastrophic for those assets. And for the moment, risk capital is still on the sidelines. Doesn't mean that it'll stay on the sidelines. Remember, in the first quarter of 2020, there were a lot of people who were writing a premature obituary for many of these risky assets. And they came back the rest of 2020. I don't think that'll happen this time around, but to me, that the big story of not just 2021 was just a peak year of the last decade, was how accessible risk capital was, not just in the US, but across the world.
Correct. I mean, that's a wonderful description of what's happened. I'm wondering also, you're a big fan of linking valuations and narratives. And I know that you followed Amazon for a long time. And part of the narrative of Amazon was it's okay to experience near-term losses to pursue market share. That has been, for a long time, and they're very good at it. And you monetize it later. That's just kind of it in a rough nutshell.
It's a field. I call it the field of dreams model.
Right. And so many companies capitalized on that narrative. And yet when you think through them, the FANGs, or what's left of them, were very exceptional companies. And not all of those 718 companies we referenced were exceptional or will be.
Right.
exceptional. How do you frame that in the terms of a narrative that's been scaled up and perhaps just overextended and is completely false? Is that still in existence?
I think the problem is, I've made the argument that you need both. You need narrative and you need numbers. And I think the problem I see in the world is you have people who use only numbers. And I've faulted old time value investing for precisely that. Is this, unhealthy focus on, when you can take Ben Graham's 12 screens and run them through. Unhealthy focus on numbers, as if numbers can essentially substitute for imagination. And I faulted founders and venture capitalists for story, and without any pushback on the numbers. I think when you look at Amazon, it is an exceptional company. It has been able to succeed for 25 years with a narrative, for two reasons. One is that it's had incredible consistency on that narrative. It's not a company that has changed its narrative every 5 or 10 years to catch the mood at the moment. And the second is, and this is really difficult to do, it's acted consistently with that narrative. The reason Amazon has the kind of believability the credibility that it does is because it's done things where you look at it and say, that's incredibly patient of them. I would give them the example of Amazon Prime. Now, Amazon Prime was initiated in 2004. For the first 6 years, Amazon Prime did absolutely nothing, stuck at 1 million members. And then it took off. Today, Amazon Prime is a moneymaker for the company, notwithstanding the shipping subsidies. But it took a long time for that to happen. And Amazon has done this over and over and over again, gone into investments of businesses, invested a lot, and 4 or 5 years in, people look at it and say, hey, this is crazy. The company's gone out of its mind. And I remember in 2008 and 2009 when Amazon had kind of had its periodic collapse. And was looking at Amazon and saying, the company is never going to make it. So when I listen to people talking about Amazon's Alexa investment or its entertainment investment and saying it'll never make its money back, Amazon has earned enough credibility in my book that when they say, look, trust us, we'll figure out a way, I'm going to trust them. But for every Amazon, there are 100 wannabe Amazons that I don't think will ever match up to Amazon's success, because one or another half of the equation is missing. Either their stories keep shifting to catch the mood of the moment, or they don't behave consistently with their stories. So I think if we can put companies to the test of not just listening to their stories, but looking at the numbers to see if they back up the story, then we'd be removing some of these fake companies pushing these fake stories out of the mix as investors.
Yeah, it's so interesting. I've heard you describe Amazon as a company with patience baked into its DNA. And when I hear you talk about narratives that companies tell the public and being consistent with that narrative and acting on that narrative, it reminds me so much of just corporate culture and how that is important. You can see that reflected in the numbers a lot of the times. So I've also heard you talk about some of the softer metrics when it comes to investing and describe them as weapons of mass destruction. Do you want to elaborate a bit on that?
I'm going to put you back on the spot. Give me one soft metric and I'll make it a number.
Okay, so a soft metric, I have a list of them here that I will go over with you. So I guess a soft metric might be a strong brand.
Okay. That's not a soft metric. That's a hard metric. A strong brand gives you pricing power. Pricing power shows up as higher margins.
Yes.
There's no need for me to talk about a strong brand after I've done a valuation if I've incorporated the benefits of a brand into my numbers already. It becomes a soft metric. I'll tell you what will make it a soft metric. Is I price a company by using a price earnings ratio, or I use a DCF where I basically made up numbers. And then at the end of the process, say, you know what? This company has a strong brand name. I'm going to add a 30% premium, or I'm going to invest in it anyway. That's a weapon of mass distraction, because you're using brand name then as not as a legitimate justification for investing in a company, but as an almost after the fact word that you're using to justify an investment you'd already planned to make. So
Mm-hmm.
brand names are actually legitimate number drivers, but if you don't see it in the numbers, then I'm going to question the company when it claims it has, for every 100 companies, it claims to have a strong brand name. 3 have strong brand names. The other 97 imagine that they have strong brand names because they've been spending, they've been around 100 years. They've spent billions of dollars in advertising. That doesn't give you a strong brand name because at this point in time, nobody might care. So I think that my point with those words is those words can have value, but if they have value, then it's your job to bring them into the numbers rather than allow people to use those words to justify investing in companies just because they want to. I'm not going to invest in Coca-Cola if it's overvalued just because you tell me it has a strong brand name. Because if I've done my valuation right, that should already be in my margins, my growth rates, my cash flows, even my cost of capital. So to me, the notion that you're going to pay for a word, a premium for a word, just because you like the word, it's well-sounding, strikes me as incredibly dangerous.
Mm-hmm. I like when I hear you describe your 3 buckets that you look at when you're doing valuation on a company, which would be revenue growth, profitability, and reinvestment.
Mm-hmm.
And so when you're reading, I guess, narrative or news on a company, you're trying to put that in one of those 3 buckets so that you can appropriately value the company. Do you want to expand on that a bit?
Those are the 3 buckets that capture your business model. There are 2 other buckets that capture risk. One bucket is for your cost of capital and one is for failure risk. So in total, there are only 5. So the way I think about it, there are like 5 folders that I have in my file cabinet.
Mm-hmm.
Every time I read a news story about a company, I ask myself, which of those folders should that news story go into? The answer might be, it affects nothing, in which case I throw it into the trash can. It's my way of screening and classifying information as I go along, because if I don't do that, I'm going to drown in data.
Mm-hmm.
Because we live in a world where there's so much data coming at us, so much, I wouldn't say information, news stories coming at us, that if you don't have a way of classifying news and data as you get it, you're going to drown in it. And human beings, when they get overwhelmed with data, actually end up ignoring data, which is why we have this strange conundrum. We have far more information and data than we did 40 years ago. And we use far less information and data than we did 40 years ago. It's one of those strange, how do you explain it? The reality is most people get overwhelmed with data. They just start ignoring it.
Mm-hmm. It's so interesting. My great uncle, who, has spent a large part of his career in the 60s, 70s, and 1980s, data was not easy to find. It was very hard for him to do analysis on companies. And it really, I think, gave him an edge. And when I consider my career and in comparison to his, I have access to so much more data. I one time went and sat down with him in the Bahamas, and he asked me to go back to Atlanta, Georgia, take a list of securities, rank them using a PEG ratio, and come back and visit him in a month. And I said, well, wait, I can do it right here in 2 seconds using Excel and Bloomberg. And he really was blown away by that. So we do have so much data. And at our company, we believe our edge is in human behavior. You do talk a lot about finding the right investment strategy to match your personality and your psychological, profile. Do you think that anybody can train themselves to be a value investor, or should everybody be focused on valuation? I know those are 2 different concepts. But can you tell me a little bit about your thoughts on different investment themes and strategies?
No, I think that I'll start with the statement that I can't back with empirical data, but I think 90% of people in markets are traders. They're not investors.
Mm-hmm.
No, and I describe the difference between investing and trading in a very simple way. investing, you value something and you buy things for less than the value and you hope the price converges on value. In trading, you buy at a low price and you hope to sell at a higher price. I mean, that's it. It's in many ways, trading is a much simpler and more honest way of thinking about markets than investing is, because there's no ego involved. You're saying, look, I don't know what the value of something is, but if I can figure out a way to buy at a low price and sell at a high price, I'm going to get rich. Most people who claim to be investors are secretly traders. I mean, the biggest giveaway of this, and this was especially true in the last decade, is I'd run into somebody who claimed to be a value investor. And I asked them to show me their portfolio. And if I looked at the top 10 stocks, 8 of them would be the stocks that had done the best over the last 2 years, momentum stocks. And I said, that's an incredible coincidence that you claim to be a value investor and all of your stocks are momentum stocks, which is a trading strategy. No, I tell people, don't play games with yourself. If you're trading, at least be honest with yourself that that's a game you're playing. Stop talking about cash flows and growth rates and fundamentals. Just go trade. The tools you might use might be charts and technical analysis, because that's more suited to trading than valuing companies. So I think the first part of making this choice has to be for you to decide whether you want to be an investor or a trader. And if you choose to be a trader, there's no judgment call that I can make on, say, you're a bad person, you're a shallow person. And we need to stop doing that. We need to decide that whatever you do, whether you're a trader or an investor, it's a choice you made. And if you're good at it, who am I to judge you? But if you choose to be an investor, accept that it's a really, really difficult game to win. Anybody who claims to have found an easy way to make money is lying right off the top. That's, to me, a dead giveaway for a grifter is when they say, I found an easy way to make money. And conversation's over right there. I'm not willing to listen to anything more that person's going to say, because I know that investing is one of the most difficult games in the world to win at. So if you want to be an investor, it takes hard work and it'll take time. And if you don't have one or the other, don't do it. Put your money in index funds and go back to living your life. You can live a completely happy, fulfilling life without ever being an investor.
It is incredibly difficult.
Yeah, Aswath, it really brings up a question. You know, we consider ourselves value investors, and we've met and spoken with a lot of people over the years, and they profess to be the same. But, you know, having this kind of valuation focus and being somewhat, you know, bound to the logic of the numbers, you know, the share price differentiates from your estimate of intrinsic value. It does happen. And when it happens and it's most obvious, so few people can act on it. What's your take on that? I mean, we're getting more towards the behavioral side, but there's so much clean logic involved. And we watched Sir John do it for years. I'm just wondering why so few people can actually stick to that discipline.
Because first, you're going to go against the crowd. And human nature makes that much more difficult than going with the crowd. The nature of investing, especially if you're going to buy something for less than values, you're often buying companies where all you read is terrible news about the company. I bought Facebook 2 weeks ago. I mean, it's not exactly the best time to buy Facebook if you're reading the news stories. But I bought Facebook because I think at a $100 share price, which is what I got it at, I'm getting an incredibly good bargain relative to the value of the company. But I have to go against the crowd and I have to be willing to wait. I mean, I didn't do it on the expectation that somehow magically in the next 6 months, Mark Zuckerberg is going to fix his wounded relations with markets and I'm going to see the stock price double. In fact, one of my biggest worries as an investor is if I'm right too quickly. Now, it's a strange thing to say, but I'd rather be right over a longer period than over a shorter period for 2 reasons. One is taxes. I mean, if I'm right too soon, then I've got to cash out way before I want to cash out. And I often have to pay more taxes. And the second is it puts me in this place of saying, I bought this 6 months ago because it was cheap. Now it's become expensive. What do I do now? So I think the 2 things that make true value investing difficult are, one is you got to be willing to go against what everybody else is saying you should do. And the second is you need time as your ally, which is an advantage I have over a professional money manager because the only client I have to answer to is myself. And I'm an incredibly patient client with myself. Whereas you have to answer to people who've left their money with you. And much as they like to tell you that they have long time horizons, sometimes they lie. They come back and say, what have you done for me recently? So I think that controlling your time horizon is a lot more difficult than it sounds in the abstract, which is one reason why I think so many people start off their journey as value investors and end their journey as traders.
Mm-hmm. Yeah, that is true. So do you feel like the investing community is more myopic now than they have been in the past? Very short-term focused on quarterly earnings, et cetera? Or do you see that from the investment community?
Trading has always dominated markets. I mean, I think it's delusional to think that investors have ever run markets. Investors have always been the minority. Now, how much of a minority varies across time. The reality is there are markets which become entirely traded markets if momentum becomes such a strong force that, price converging on value becomes almost impossible to see in your lifetime or mine. So I think during incredibly buoyant markets like you had over the last decade, even the minority that are investors tend to become an even smaller minority. So it ebbs and flows. I mean, there will be times when investors have their turn again. But I would say both sides have to be cautious about crowing about their victories because it doesn't last. Markets have a way of bringing us all back down to earth. So if you have the temporary period of feeling like, telling traders, look, you guys were wrong. And I try to restrain myself from lecturing other people on how short-term they've been and how this is punishment that is deserved, because that's going to come back at me 6 months from now, a year from now. Because there, but for the grace of God, go I. I mean, I think of markets as being the ultimate taskmasters here. I mean, they're out to capture you in your arrogance and bring you back down to earth.
Mm-hmm.
So true. Keyword there, arrogance. One of the things that Sir John really expressed to us and others, he wrote a book actually called The Humble Approach. He was an avid exerciser on the idea of intellectual humility. And you've touched on that, I think, in some previous talks. What are your thoughts there and the role of intellectual humility in investing?
I mean, the reality is that none of us really knows more than 10 or 15% markets. And that's pretty much, that's kind of a ceiling. There's so much we don't know and you can pore over history and read every book that's been written, but the reality is the future will deliver surprises you've never seen. And so John was way ahead of his time in emphasizing humility, because you've seen what happens when investors get arrogant. I mean, think of Master Son. I mean, who makes 300-year plans other than the most arrogant of people? And when you team up arrogant VCs, suppliers of capital, with arrogant CEOs, you have a match made in hell. I mean, WeWork to me was an accident waiting to happen. The amazing thing was it happened before the IPO rather than after the IPO. But we've spent a decade putting people on pedestals, treating them as geniuses just because they founded companies. And I think we're going to pay the price for that, because we've given these people power in perpetuity with voting shares and non-voting shares. It terrifies me, because I think human beings, when they're given that much power, no matter how smart they are, will find a way to bring themselves down.
So true. One question I have, just in kind of focusing on those last comments in terms of valuation, how routinely, in your view, do you see the abilities of one person, a CEO, kind of a celebrity CEO, if you will, get overcounted in the valuation of the stock? Is that prevalent in your view?
Are we talking about Tesla and Elon Musk?
Yes.
I mean, I think in general, personality-driven companies are dangerous simply because human beings live finite lives. And it's not just Elon Musk and Tesla, right? For the last 50 years, we've had one of the most personality-driven companies of all time in Berkshire Hathaway. Mm-hmm. I mean, we've thought of that as a good thing, but the reality is Warren Buffett is 90 years old. And if you've been paying a premium for Berkshire Hathaway because he's going to be picking stocks for you, it's time to let go of the delusion And I think that anytime you have a company's value tied to a person, you face more risk than when a company's value is tied to a product or tied to a business model. I mean, I think the very best companies, here's what happens. Founders find a way to make themselves dispensable. I mean, I've said some mean things about Microsoft in the past because I'm an Apple user, but I've always admired the way Bill Gates walked away from Microsoft when he was a relatively young man and never looked back, never tried to interfere in how the company was run. And, much as we see Jeff Bezos in swimsuits in strange places now, he's also figured out a way to make the transition where he doesn't seem to be interfering in how Amazon gets run or second guessing Andy Jassy. So it takes a very special skill. And we talked about, not being arrogant. It's being willing to let go of your ego for enough time to say, I built this company, but I want to let this company outlast me. So when I look at companies, one of the things I look at is how dependent is this company on a person? And the more dependent it is, the more I worry about it. And it's not just in the US. I think of Reliance in India and, Mukesh Ambani being the person that people think of when they think of Reliance. And as an investor, that scares me a little bit. I need to know, especially with family group companies, that there's a transition in place. Now, you see this playing out at Disney right now, right? Where Bob Iger made the mistake of 7 years ago not stepping down when he said he would. He cleared his bench because everybody was supposed to be moving up behind him, kind of left the company. And 7 years later, they're in a terrible position because he's had to come back to fill in a slot that was filled by somebody who was ill-suited. So I think having a management or or top CEO who arranges for a transition that is smooth adds value to a company. We don't factor enough in valuation, but we need to.
Mm-hmm. I want to inquire a bit about your sell discipline because we had a very similar sell discipline a few years back, and we've revised that a bit. But you sell a security when the security has approached your approximation of intrinsic value. Is that correct?
When it has gone above my intrinsic value. I mean, there's a threshold it has to go above, partly because there's noise in my value. I'm fully aware that when I value something, I can screw up. So just like I wouldn't buy something just because it went just under my intrinsic value. I'm not going to sell something just because it just exceeds my intrinsic value. Actually, when I value companies, I use Monte Carlo simulations, which allow me to get a distribution of values. And so if I were to give you a very simplistic rule, I buy when the price hits the 30th percentile. I'm going to sell when it hits the 70th percentile. So there's range on both sides of the value, but I'm symmetric. If I'm going to buy something because it's undervalued by 20%, shouldn't I be willing to sell when it's overvalued by 20%? It seems to me inconsistent to have a one-sided value investing rule, because whatever rationale you give for not selling when it's overvalued by 20%, I can flip that rationale and say you shouldn't be buying that when it's undervalued by 20%. So I do sell stocks when they get overvalued. I'll tell you the trickier part, though, is when you buy something that's undervalued, it stays undervalued, but the value keeps going up because it keeps doing better and better, and it starts to become a larger and larger part of your portfolio. This is every investor's challenge. Is your biggest successes start to take over your portfolio. They start at 5%, but if they really go up, they could become 25, 30, 35. I mean, I heard that Apple is now at 35% of Berkshire Hathaway's holdings. And to me, you're hitting a danger zone. So there are two things that cause me to sell. One is when something gets significantly overvalued. The other is when I start to worry about it becoming too big a part of my portfolio. My threshold is that no investment in my portfolio should exceed 15% of my overall portfolio. Why? Because I know I can screw up. And if I have something that's 30 or 40 or 45%, no matter how much I love the company and how well it's done for me, I'm now approaching a danger zone where if that company collapses, it can take my portfolio down with it. So I think we talked too little about selling, too much about when to buy, too little about when to sell. But I think we need to have an honest conversation as investors about what's our philosophy on buying. But we also need to have just as honest a conversation about what's our philosophy on selling, because you can't think about it after the fact. You find a way to rationalize holding a stock which is overvalued, rationalize holding a stock that's become 40% of your portfolio. If you don't have ironclad rules about what you do or when you sell.
It reminds me so much of my Uncle John. He did have those rules in place to save him from himself, as he would say. I think sell discipline is very important. We have toyed with ours over the years. We do have a portion of our portfolio where we will sell the position as it approaches intrinsic value or exceeds our estimate of intrinsic value. And then we have other securities that are compounders that will remain in our portfolio longer. But Uncle John had an interesting sell discipline, which is he would sell if he could find something that was 50% better. Is that right, Scott?
Yes.
So that was an interesting sell discipline too. And we remember that here. So we're, always looking for replacements for all of our positions to see if we can find better opportunities.
Well, that makes sense if you don't have any cash in your portfolio at all. But if you do have cash, that I would assume is what your cash is for. But if you're fully invested in a world of plenty, where there are plenty of opportunities, I think it makes sense to keep looking for better opportunities.
Yeah. And then in regards to discipline, I'm reminded that there is so much focus among investors on buying when the market falls in value. And it's almost it's equally as important to avoid the great insanities. So when everybody's making money and the market's overpriced, to avoid the temptation to jump in. How do you have any tips or strategies for avoiding insanities and helping with the behavioral aspect of investing?
My advice to people is stop using the word value when you talk about the market. It's pricing. So if you are going to buy when the pricing drops, you're looking at only half the equation. Pricing can drop for a good reason. In other words, because you're in COVID and you might not be able to generate any revenues for the next 6 months. So I think that buying, I call these knee-jerk investing strategies, where you buy because the prices drop by 30%. But what if the values drop by 50%? Most of the time, I've discovered that when people talk about intrinsic value, they're not talking about intrinsic value. They're talking about some version of pricing that they're using and claiming it's intrinsic value. 20 times earnings is my intrinsic value. That's not an intrinsic value. That's a pricing. So I think for every 100 people who talk about intrinsic value, maybe 3 or 4 actually compute intrinsic value. I actually gave a talk in Omaha to the Berkshire Hathaway. I mean, I've never been to the meetings themselves, but these were the portfolio managers who go to Omaha every year. And I asked them, when was the last time you actually valued a company? They all claimed to value the company. But when you dug a little deeper, it turned out that very few people in that room had actually valued a company. They'd price companies. They had all these metrics they used. I use 6 times earnings, or I use book value. So if you really are doing intrinsic valuation is all about thinking about the future. So you talked about your compounders. The compounders, even if the price goes up 50%, if they're actually compounding earnings, their value will be going up as well. So in a sense, if you have a full intrinsic valuation, it should capture all of the stuff you think will make this company a good investment for the long term. So I'd suggest that people separate what markets do, which is to price companies, from what they should be doing as investors, which is valuing companies. So just because the price is down doesn't make something a bargain until you look at what's happened to its value.
That's a great way to look at it, Aswath. One question that came up while you were speaking was just the role of reinvestment and how certain companies can actually increase their intrinsic value along the way. Who have you encountered that's actually good at that, and how did you handle it from a valuation standpoint?
In fact, I mean, it's the only reason for growth is because you can earn a return that exceeds your cost of capital. Growth is, I think Buffett said it as well, which is growth by itself is neither here nor there. It can be good, it can be bad, it can be neutral. And what determines whether growth is good or bad for you is how much you need to reinvest to get that growth. So if you take a first corporate finance class and you take a capital budgeting session, we talk about net present value. Kind of an exercise we go through, and so I'll never look at that again. But if you think about companies taking projects, you want them to take positive net present value projects. But the reality is 2/3 of companies globally, and I look at 47,000 publicly traded companies at the start of every year, 2/3 of those companies had returns in capital less than their cost of capital. Now, some of them might have had good excuses that they might have had a bad year, commodity prices were down, whatever. But half of all global companies, I think, destroy value as they grow, which means when they talk about growth, I should be knocking down their value, not increasing their value. So when you look at reinvestment, it's really to answer the question, is growth good for this company, bad for this company, or neutral? And that's a critical question. It's a question that I face with Facebook right now. They have a $100 billion planned investment in the metaverse. The problem is, I'm not even sure what the business that they're going in to the metaverse for is. And right now, the market is assuming that it's not just that it's a negative net present value investment, but that they're throwing the entire $100 billion into a hole in the ground and they're never going to get any cash flows back. That strikes me as extreme. But that's at the heart of why Facebook is melting down right now, is people look at the reinvestment and they're not convinced that there are going to be any cash flows to back it up. So reinvestment and growth are twin variables. You can't talk about one without the other. A company that reinvests a lot and doesn't grow is a value trap. A company that doesn't reinvest very much and grows a lot is your superstar. So you're looking for that mismatch between growth and reinvestment to find a company that is going to, kind of have explosive increases in value over time.
That's exactly right. And so many companies, though, and management teams tend to exploit that narrative and say, well, these are our growth opportunities and we're reinvesting. In your experience, though, that sounds pretty rare that they can actually execute and do that over time.
In fact, they hardly ever talk about reinvesting. They talk about the growth. In fact, they talk a lot about growth, especially revenue growth, but nobody seems to talk about how much they would need to reinvest to get that revenue growth. Mm-hmm. So it is, in fact, the test I would run on potential is you want to take your revenues, increase them 20-fold over the next 10 years. Okay. How much will you need to reinvest? And don't tell me you're in a capital light business. In fact, one of the terrifying things I found when I looked at technology companies, which are viewed as capital light, is how capital intensive they actually are. The only reason they look capital light is accountants miss the capital intensity of these companies because they often take the form of either acquisitions or R&D. So I think with every company, the test you got to run is don't let them get away with, hey, just talking about the growth. Put them on the spot and ask them, how much will you need to reinvest? Where will you need to reinvest? And how can you convince me that this reinvestment is actually going to have a payoff?
And as a follow-on, how do you do that in an environment where liquidity and easy money is quickly vanishing?
Well, you've got to be willing to walk away from the table.
All the more difficult today, right?
No, the reality is nobody's forced to invest in a company. So if you're not satisfied with the way they answer it, let somebody else invest in the company. Let them deal with the consequences. I've never felt the urge to explain what other people pay. One of the most frustrating things in markets. If they want to pay 50 times revenues for a company that has to reinvest huge amounts to get its growth, well, they're welcome to the company. I'm not going to point fingers at them and call them bad investors, but I don't want to be part of that investment.
Correct. And I was also just kind of hinting at the ability to access the capital in this environment of Fed hawkishness and rising rates and tightening liquidity. It's not such a given that you can even find the capital to reinvest.
That's a very good point. And I think that especially in the US and Europe, we've assumed that a going concern is an easy assumption to make. Why? Because companies can always raise money to cover their capital needs. But I remember even in the US how things were in 2001 or 2009. Now, all you need to do is remember a little history to know that many of these companies that are cash burning machines will have trouble making it. They're going to have to sell themselves at fractions of fair value because they can't raise the capital to keep going. So I think that's a very good point. And that's why I have my failure risk component when I do intrinsic valuation. It becomes my metric for adjusting for the fact that if you're a cash burning company in a market like this one, I'm going to attach a higher risk that you will not make it because you might not be able to raise the capital.
So true. And so few people have seen that, as you pointed out, 2009, 2001. These are, strikingly isolated events, actually, over the last 20 some odd years. That's just how long we've
It doesn't happen. It doesn't happen that frequently. But I think it's one of the advantages that emerging market investors have over developed market investors, because they've seen it happen over and over again. They're less likely to make these cavalier assumptions. If you're a Turkish analyst or an Argentine analyst, this is par for the game. Failure risk becomes a key part of thinking about value for a company. We're lucky to live in an economy where it's not the norm, it's more the exception. But it still does happen. You got to factor it in.
Mm-hmm. When you think about investing around the world, I'm assuming you have a global perspective. Do you have any holdings personally outside of the United States?
Oh, quite a few. Because I don't do consulting or expert witness work, but I teach all over the world. I almost always pick a domestic company to value. And if I do find it undervalued enough, I've had no qualms about investing in that company. I have Brazilian holdings that I got in 2002 and 2003 when Lula had just first come in his first round as president. People were selling off every Brazilian company. I remember buying Embraer then, because I said it's a Brazilian aerospace company, but it gets 97% of its revenues outside Brazil. I didn't see why it should be marked down like every other Brazilian company. So my portfolio is a fairly healthy collection of these companies that I've valued and found undervalued along the way. I tend to avoid markets where the macro story is so strong that my company valuation could get drowned out by a macro shock. Mm-hmm. But I'll give an example, value Russian company or a Chinese company. I might find the company to be undervalued, but the government is a player in the story. And I don't feel comfortable when governments are big players in my valuation story. So those are the markets I tend to avoid, where I'm very dependent on the government being my ally rather than my enemy to succeed as a company. Because I think that's a dangerous place to be.
Yeah, I agree with you. Sir John would have definitely agreed with you, and he avoided autocracies. He did invest in China, but that was when China was opening up. Mm-hmm. I'm curious, your home country is becoming such a popular investment destination. Do you have any thoughts on investing in India, even though that's a very macro question to ask?
Well, I think India has opportunities, and it has lots and lots of, potential pitfalls as well. I think investing in India without understanding India can be very dangerous, because I think you can't assume that what happened in the US is going to work in India as well. So when I see somebody pushing up the price of Zomato because it is like DoorDash, but it can serve 1 billion people, I tell them to be careful about scaling up stories that worked in the US into India and expecting it to work there as well. So, I think that India is an attractive destination simply because money needs some place to go. And now that China's become a much more dangerous place for money to go, where else can you go? The reality is India is the only big enough market to go into where there's potential growth. So I think some of this is almost by, because everything else has been excluded from the game. So, as Indian investors, they're going to benefit from this inflow of foreign institutional investment. But I think if you're a foreign institutional investor or a foreign individual investor, I would say learn a little bit more about India before jumping in with both feet and putting your money into Indian stocks or Indian mutual funds, because you can still get yourself into a lot of trouble.
It's great advice.
Well, speaking of advice, I know you have a constant audience of very young, bright minds, many of whom are interested in investing. What advice do you give them as they seek to enter the investment industry?
First, don't invest to get rich. Invest to preserve and grow your wealth. It's a mindset change. In the last decade, one of the things that's terrified me about young investors entering the market is they've got their head screwed on wrong. They want to invest in markets because they want to get rich. They've seen somebody else buy Bitcoin at 100 and seen it go to 10,000.
Mm-hmm.
You can't invest. If you enter the market hoping to get rich, you're going to make some really big mistakes along the way. It's tough to tell that to a 25-year-old. You got to be patient. You got to build up your wealth but it is, I think, a good lesson to learn. And sometimes the only way you learn it is with the harshest of lessons, which is you try to do something too much too soon, and it blows up in your face. But I'd say be patient, build your wealth, and be clear about what you hope to get out of markets. Markets are there to if you don't have a job that gives you a decent income, it's going to be very difficult for markets to bail you out. So take care of your career, take care of your life. Try to earn an income and save some of it, and let markets be your mechanism for taking those savings and magnifying or compounding them over time.
It's really good advice. Are you an advocate, or could you be an advocate for passive investing?
Oh, absolutely. I think for 90% of people, it's the right way to go.
Mm-hmm.
They have no business being in markets as active investors in the first place. I mean, we mentioned one reason, which is the investing world has become a lot flatter. 40 years ago, if you collected data, you were already way ahead of the game. Yeah. If you were able to analyze data, compute ratios. Remember, to compute ratios 40 years ago, you actually had to collect the data and compute the ratios by hand. I tell people, look, to run the gram screens in the 1950s would have taken you weeks of work. Mm-hmm. And who had the time to do it? So if you did it, you're way ahead of the game. Today, to have a niche in markets, to have a competitive edge, I mean, you got to really stretch. And most people can't make that stretch, which means you're better off passively investing and moving on with the rest of your life.
Mm-hmm. Are you seeing your students, do any of them have just any amazing ideas or creative ideas when it comes to investing that you think are going to really impact the industry in the future?
Most of them think that technology is going to be their niche, artificial intelligence, mm-hmm. big data. And I have some very simple advice for them, which is if everybody has it, nobody has it. Mm-hmm. And my view is AI and big data, active investing is in trouble. It's been in trouble now for 40 years, but it's kind of accelerated over the last decade.
Yeah.
AI and big data are not going to bail it out. So many of them are excited about technology and how it's going to make them into better investors. And I tell them, look, that's not going to save you. It's actually going to make your life worse, more difficult, because you're going to get constant feedback and figure out a way to deal with that in psychologically healthy ways.
Mm-hmm. I agree. Well, thank you so much for the time you've spent with us today and
You're welcome.
All of the questions that you've answered. We've really enjoyed it.
Thank
Absolutely.
you. I've enjoyed it too.
Thank you for listening to Investing the Templeton Way. Please be sure to subscribe on your favorite podcast player. To view the show notes and resources mentioned in today's show, head to investingthetempletonway.com.